Hello and good afternoon to everyone that is currently tuned in live with us on another episode of Philip Trading Podcast. I'm your host for today and my name is Tran. With me here today is our honored guest, Daniel Ang, a professional trader with more than 30 years of experience in the financial industry. How are you today, Daniel?
Very good, Trent.
Okay, nice to have you back. So for today's podcast, we'll be sharing a preview of our upcoming webinar on this Wednesday, 11th October from 7:30 p.m. to 9 p.m. The title of the webinar is US Equity Markets Outlook. So to all our audience out there that are currently trading the US Equity Index, do not miss out this webinar and quickly register for the webinar at Philip Capital website. Once again, I would like the help of all our beloved audience today to share this video to all your friends. The more people that are watching this video, the more we are motivated to deliver greater content to all of you. So without further ado, let me introduce our esteemed speaker for the upcoming webinar to all of you. Daniel Ang began his career trading commodity futures in 1985. After a successful move to trading Hang Seng Index futures in 1987 and profiting from the 1987 stock market crash, he continued his career in finance. He became a gold dealer in 1989, joined Standard Chartered Futures in 1992, and then marketed SJX MCSI Taiwan Index Futures. So in 2007, he represented Gateway Capital Hong Kong for the Chicago Mercantile Exchange. During the 2009 financial crisis, he helped launch an FX company in Dubai. In 2012, he founded the Traders Academy International Proprietary Limited and became a sought-after speaker and also a coach in Asia Pacific and Europe. In 2020, during the pandemic, he authored The Accidental Trader, and Daniels remained an active trader and mentor aspiring trader through his mentorship program. So now, let me pass on to our speaker to give a preview on the upcoming webinar and why you should not miss out this informative session. Pass on to you, Daniel.
Thank you very much, Trent. That basically sum up my background. And if you have been watching the markets over the last month or so, you would have noticed that stock market since the start of September has been moving in one single street. Basically, it's coming down, and this is likely to be continued forward in the coming weeks itself. Now, we have seen one whole month of downward move, basically correcting what the market has been doing since the last October itself. Okay, does that mean that the rebound that we see in equity market is basically over, or are we looking at just a technical pullback before the market goes to new high? So the thing is, we need to know what is driving the market of late. We all knew that the US debt has already ballooned to $33 trillion, and the US Treasury needs to raise money because they have a shortfall in their budget, meaning to say that whatever they collect in taxes is not enough to pay for the government spending that the President Biden wants to spend on for the balance of his term. Okay. And next year, we're going to have the presidential election. So because of the shortfall in the budget, the Treasury needs to issue a huge amount of debt instrument, basically what we call the treasury bonds. And this is operating in a climate in which the Federal Reserve, which is the US central banks, has been raising interest rates very aggressively since last March, from almost 0 to 5.5%, with the possibility of one more rate hike before the year end is over. So this is the environment in which we are operating, and it's also the reason why treasury yields has skyrocketed. Okay, in just 1 month, the short end of the treasury, I would say the short end, I would say the medium term, the 10-year notes has already seen yield increase by 20% in just 1 month. This is very, very scary. So this is actually causing a lot of capital to leave traditional markets, including risky assets such as equity markets, into the safe harbor of US Treasury. So this is the main driver causing equity market to basically come off. And it does not look like this driver is going to disappear anytime soon. And if there's anything, I think it's going to increase the pressure going forward. So this is the environment that we are looking at for the rest of this year. Okay. Now, if you can, I would like to share some of my chart with you. Can you allow me to share my chart, please, Tran?
Sure.
All right, here you see these are the three main drivers, in my opinion, that is driving equity markets. In fact, it has been the main driver across all asset classes. We have seen bond prices basically has been collapsing, and now because yields and bonds are basically moving in opposite direction. The price of the bond is not the same thing as the yield of the bond. Let's say you buy a debt instruments, you pay for the price of the bond itself, but the yield, which is the interest you're going to collect, is exactly the opposite move. So it is inversely correlated here. And it is this rising yield, okay, that is causing bond prices to collapse. And we are seeing a collapse right now in bond prices, which is very, very severe. It reminds me of what happens before 1987. We are basically seeing the same thing, okay? And if you have never seen what happened in 1987, I have the privilege of actually living through that episode. And I have actually seen for the first time in my career what a contagion looks like. Basically, stock market falls like 10 pin around the world, okay? So this could be what we'll be looking at if this thing continue at its current trajectory. So it's a function of raising more debt. If the US Treasury, which is the so-called the Ministry of Finance in our term here, wants to borrow more money, they have to issue more bonds. And if the bonds is oversupply, right now there's a overwhelming oversupply of bonds, because at the same time as this is ongoing, we also have a de-dollarization movement that's going on, okay? And this is largely as a result of what happened in the immediate aftermath of the war in Ukraine, whereby the US and the West actually weaponize the dollar, weaponize the payment systems, and this is causing all other nations to sit up and take notice that today I may not be in the back book of the United States, but if one day should they come under scrutiny by the United States and they don't like what you are doing, they may actually do to the rest of the world what they did to Russia, which is basically kick them out of the global payment system called SWIFT and basically freeze their dollar assets. So this is something that is worrying the bank, which is the reason why behind we have the de-dollarization. So right now, we have seen ever since the trade war started by Donald Trump back in 2018, and this thing has escalated during the current administration of President Biden. And there is this worldwide movement to actually reduce holdings in US Treasury bonds. And not only are the main country that has been buying US Treasury bonds basically unloading their holdings of US Treasury, we also have allies of the United States are also at the same time lightening up their holdings of US Treasury bonds. So basically you have buyers who traditionally buy your bonds, now they are no longer buyer, and now worst thing, they are actually selling. And then on top of that, we have the US Treasury trying to sell new bonds, and the issue that they are selling has escalated because the US national debt has ballooned to $33 trillion, and it looks like it will grow even bigger in the years to come. So under such a condition whereby we have a total imbalance in demand and supply. Supply right now is massively oversupplied, where you do not have enough buyers. So that's the reason why bond prices has been coming down. And that's the reason also why the yield has been shooting higher. And this is going to impact negatively all risky assets, in particularly equity markets. So we have seen since the start of September, we are only in the first week of October, but we are still basically seeing the same thing. What happened in September is rolling over in October. And in October, is historically speaking a bad month for equity markets. I would say it's very regular for October for some reason sees the biggest move in equity markets to the downside. So this is something that we have to watch out. We are possibly looking at something very, very big. Then of course, we have this thing that's fit into this narrative. As US yields goes higher, it not only impact the US equity markets, it is impacting all the global economy, because when you have yields that are so rich, money managers from around the world look at the yield that the US Treasury commands. They will be tempted to actually move into US Treasuries, hopefully to be able to earn the yield, okay? Because capital is international, there is no border, and capital can just move into another territory at the click of a button. And this is what we are seeing. Capital flow has been flowing from east to west into the United States, not only from the east, but it's all over the world, whether it's from Europe, whether it's from Latin America, whether it's from Africa. All the capital has been sucked into the United States like a big giant vacuum cleaner because the yield is so attractive. Okay, later on I will show you what are the yield that you can have by simply parking your excess fund into US Treasuries. And this is again feeding into the demand for dollars. So before you can buy US financial products, okay, you have to own US dollars. So basically what you need to do is take your domestic currencies, you buy the US dollars, and then you use the US dollar holding to invest in US assets. And this could be US Treasuries, okay? And this is also causing all the other economies, especially in the developing world, to actually see a capital outflow massively. And these are negatively impacting the exchange rate, which also fit into the economic slowdown that we are seeing, okay? So everything works in a circle, okay? We have high yields attracting foreign demand for US treasuries, in which they also cause a shortage of US dollars outside of the United States. And this is causing the dollar to actually surge higher. In fact, the timing for this equity move, okay, into the downside in September is also accompanied by a rebound in the dollar, okay? You just have to look at your own currency to get a sense of whether your currency has weakened over the last month or so. And this is exactly worldwide phenomenon. Everywhere you go, you see foreign currencies has been depreciating relative to the dollar, and this has a negative feedback loop. And will the interest rate stays low? Unlikely. Okay, now going into last month, there was hope that the US Federal Reserve, which is the central bank, may actually cut interest rate going into 2024. In fact, the market was expecting a 1% cut going to 2024 because 2024 happens to be a US presidential election year, okay, which will take about 12 months, 13 months from now, okay? Yeah, in November of next year, they will have the presidential election. Now, usually in a presidential election, the central banks will actually pursue policy that is actually quite friendly to the incumbent. Currently, it is the Democratic candidate, which is going to be President Biden. He has already put his name into the ring and said that he's going to contest for a re-election. Okay, so assuming he actually get the ticket to actually contest for re-election, okay, he will definitely want to deliver goodies before the election during the campaign itself. So a lower interest rate will bring down, hopefully, the cost of everything that the Americans are paying for. Right now, inflation is still raging away, although the official CPI numbers is suggesting that they have already seen peak inflation. But I can tell you, it is not. We can even ask ourselves, are we paying more for our groceries? Although we are not living in the States, but we are basically suffering under the same monetary policy pursued by the central banks in the States. Okay, so this is higher for longer interest rates. The Fed chairman during the last month FOMC, which is the Federal Open Market Committee, after they hold rates constant at 5.5%, he actually released a statement that suggests that going into 2024, there won't be a 1% cut. At most, we are looking at 0.5% cut. And this is causing market participants to actually rebalance their portfolio by actually exiting out of the risky asset, which is basically equity market. So this is what we are seeing, okay? And of course, going forward, this is what we are seeing. This is September, okay? Not too long ago, 2 weeks ago, we have this news that hit Bloomberg and say that the yields in the US 10 years treasuries. Okay, now the US treasury issued various debt denomination in with varying maturities. We have as little as 1 month, okay, 2 months, 3 months, all the way to 1 year. And then those are what I call the treasury bills. Okay, anything below 1 year is treasury bills. Those are very short term in nature. And then you have the medium term note, those 10 years and 20 years. Okay, maturity. This is what we're talking about. Usually the 10 years is the benchmark people look at in terms of yields. Okay, so the 10 years is actually a medium term note. Okay, that actually costs. You can see that the chart on the right here, it has been escalating since April. Okay, so this is just feeding on by itself. Okay. Then what we see here is, of course, this higher yield is attracting a lot of foreign capital into the United States that fit into this narrative. So this is definitely going to be a while. Although over the last 24 hours, this yield has dipped a little bit ahead of tonight's non-farm payroll. So do watch out what happened tonight, okay? Because it will have implication going forward into next week. Now, what is causing the yield to surge? One, higher for longer interest rates. Okay, this one we already know because the Fed chairman has basically said that there is no chance that he's going to cut interest rates. So interest rate may not raise, okay, may not go higher beyond the 5.5%. Okay, personally, I think there's going to be one more rate hike, maybe by another 25 basis points to bring the total interest rate to 5.75%, which will put the Fed fund rate anywhere between 5.75% to 6%. Okay, and this is going to stay there for a while. Okay, no cut, but it's going to stay elevated. So this is already laying the condition for higher interest rates. Quantitative tightening. Now, if you are not familiar with this quantitative tightening, you probably will heard of this term called quantitative easing, what we call QE. Now, during the pandemic, okay, and even before that, during the 2008-2009 financial crisis, they experimented with this non-conventional monetary policy in which they are basically printing money, full stop. Now, quantitative tightening is exactly the opposite now because of how they have launched multiple rounds of QE program, flooding the banking system with excess liquidity to the point whereby they are trying to create inflation. Now that they have inflation, they are trying to roll back the QE program. In fact, they have been rolling back the QE program for more than a year now. And the Fed chairman has just, or rather the Fed has just announced the latest data. They have managed to bring down $1 trillion from their balance sheet. Okay, from almost $9 trillion, they brought it down now to below $8 trillion. So that is what we are seeing. Now, this is, in another word, okay, instead of hiking interest rate, quantitative tightening has the same impact as hiking interest rates. Okay, so do watch out. It has the same impact. Okay, different names. Then the other one is tighter lending standard. Now, if you remember what happens in March of this year, we heard of SBV Bank, we heard of Signature Bank, both collapsing, and then we have Credit Suisse collapsing. That is a major institution. So what happened during March is still very much with us, because during the low interest rates period during the pandemic, banks will have to force to look for yield. In those days, interest rate were near zero. There was simply no yield. So they bought whatever they could get their hands on. And in those days, those bonds paid very little, okay? And they have bought quite a fair bit of them. And now, 2 years later, we can see that US interest rate is at 5.5%. That means to say whatever they bought 2-3 years back during the pandemic, now those assets are underwater, okay? Meaning to say that those assets that they bought are all losing money if they mark to market right now, okay? It would have been no problem if they hold all these assets into maturity, in which they will get back their principal plus the coupon rate, okay? But what happened was, in March itself, bank depositors wants their money back, okay? When 1-2 banks start to fail, the others will say, will my bank be the next bank to fail? So what they did was they go to the bank and say, I want my money back, okay? And if one person wants the money back, that's fine. But if everybody wants the money back all at the same time, this is a classical bank run, okay? Basically, the bank do not have the money because the money has been reinvested or has been loaned out to either individuals or corporation, and you just cannot recall back those loans at the dime, okay? So basically, they have to sell their assets, which costs subsequently the banks will tighten their banking lending standard. Meaning to say anybody now who wants to borrow money for whatever reason now will have problem getting loans. And this is also true for cooperation. US companies needs loan, they can't get loan right now. And this is again having the same impact as higher interest rates. Okay. Now the other thing is, of course, they have been selling us the narrative that the US economy is strong, okay? Based on all the data we have seen, whether it's the CPI numbers or whether it is the GDP numbers, it suggests the US economy is doing A-okay, okay? That means to say that while the rest of the world economy has slight, okay, US economy seems to be very resilient. And that means it gives the Federal Reserve more excuse, or at least the cover, okay, to actually have the option to hike interest rate higher if they want to, okay. So all this is leading to this thing called surging yield, okay. These are all the contributing factor, okay. Now, the debt that we talk about, the US debt has just crossed over to the $33 trillion. Now, remember, just not too long ago, at the end of May, the US debt ceiling has been hit, and there were like talks that the US cannot borrow anymore because the law states that once you hit the ceiling, you need to go back to Congress to get permission to raise the ceiling or to remove the ceiling altogether. And there was talk that if they cannot get it done, the US is likely to default on their obligations. Means those who have bought US Treasury bonds may not get paid. Okay, and they do not want that, because if that happens, it means that they have technically default. And US has always been very proud that they have never defaulted before. Okay, at least they are able to pay the interest on their loans. So that was, at that time, that was end of May. The US debt total was $31.4 trillion. And from June to October, only 4 months, the US has taken on another $1.6 trillion in debt. And this is very scary because it took the US more than 30 years to accumulate $1.6 trillion of debt. And now it takes them only just 4 months. So it means this thing is unsustainable. Okay, that means the US Treasury would have no choice but to borrow to pay off the old loans. Take on new loans to pay off the old loans. And what does it say? What does it look to you? Okay, it looks like a major Ponzi. Okay, so if that's what you can deduce from this scenario here. Okay, so because of the higher interest rate, the Treasury needs to borrow even more, and this is causing them to actually pay more in terms of yield. Okay, because now the buyers who traditionally buy your bonds now are no longer buying. Now, in order to attract new buyer, you have to pay more in terms of yield. Okay, and this is exactly what's happening. And what impact does it has? When the US Treasuries are in the open market competing for funds, okay, they are also competing with the other traditional institutions for fund. The banks needs to raise deposit base. Now, we had that banking crisis back in March, in which the smaller regional banks are losing the deposit base to the bigger bank. But the bigger bank said, I'm not competing with you, okay, I don't need your deposits, but since your depositors come to me, okay, I will take them, but I won't pay them market rate. So what happened is, right now market rate is about 5.5%. That means to say the bank can actually take this deposit, put them overnight into the money markets, and earn 5.5% risk free, and they only pay the depositor less than 1%. So depositor take a look at this situation. They don't like what they see. They say, now I'm not even going to put my money in the bank. I want to put my money in the money market. You can see this is the yield that they can get. If I put my money with the US Treasury, I lend money to Uncle Sam. For 3 months, I get almost 5%. And that is considered risk-free. Why should I take my chance with the banks, knowing that the bank may actually fail? So this has the indirect impact as the US Treasury compete with the traditional banks to raise money. So what happened? The smaller banks are dying because on the one hand, they are losing the depositors. On the other hand, if they want to keep the depositors, they have to pay higher rates, which they can't afford. Okay, so over time, we may see a banking crisis 2.0 all over again, and this is going to be something that we do not have to wait too long to see. So this is having that knock-on effect. So basically what I'm trying to say, that there's a lot of risk right now in equity markets into the balance of this year and maybe even beyond. So we want to be ready for that when that actually happens, because all the signs are there. Okay, and just look at the Russell 2000. When we meet again next week, I'll be showing you various charts. Basically, we're going to be showing you the Dow Jones. Okay, I'm going to show you the S&P 500, the Nasdaq 100, and of course the Russell 2000. And Russell 2000 may sound a bit unfamiliar to most of us because it is a minor index as far as you're considered, because these are small cap index. But this index right now is the weakest link because most of the regional banks are component stocks of this index. And if you believe that a banking crisis is going to come rolling back again, this index will be able to tell us where the market is heading. So this will be something that we'll be talking about during next week's webinar. And I hope you guys can come around because we are at that crossroad right now. Okay, the market structure has actually changed from where we were just simply 3 months back. Or in fact, at the end of August, the market was still doing very well. But come September, okay, we see that there is a change of character in the marketplace itself, and because investors are moving their money, okay, and so should you. All right, guys, Tran, this is exactly what I want to say.
Okay, thank you, Daniel, for the wonderful preview. And once again, to our all audience, please tune in to the exciting webinar on this Wednesday at 11 October from 7:30 p.m. to 9 p.m. And to all audience who are interested or currently trading the US equity index, Phillip Capital is currently having a promotion known as Trade and Earn with Phillip. So clients can earn prizes such as iPad, Apple Watch, AirPod, and also other great prizes when they trade any products with Phillip Capital, and the CME equity index is included as well. So for more details, you can drop us a message on Facebook and our representative will get back to you. Alternatively, you can also visit our website, and under the promotions tab, you can find more info on the promotion. Lastly, before we end, if you have any question or any topics you want us to discuss next week, you can message it in the comment box below. Okay. So thank you for listening to our podcast, and happy trading for the week. Thank you for your time too, Daniel.
Thank you very much, and I hope to see all of you next week. Bye.
Thank you. Bye.